All right, there we go. Happy Friday, everyone. I hope everyone's having an amazing week. We're gonna give people a couple minutes to get on in here. In the meantime, grab a pen and paper. We got some seriously amazing stuff to cover today. I'm excited. Okay, so this is new and fun, right? All right, disclaimer and anti-guarantee. All right, so welcome to Remote Multifamily Investing Academy. Before we move forward with this training, please note the following important disclaimers. This training is solely for educational and informational purposes and is not considered as an investment advice or an endorsement of any particular investment strategy. All right, guys, the success stories and the results that we share are not typical. Everybody doesn't hit those, right? They depend on a variety of factors like background and dedication and application of the material. So essentially, your experience will vary based on your effort, the education that you get, the business model that you employ. And then, of course, there's market conditions beyond our control. All right, now let's discuss our anti-guarantee. Despite our commitment to delivering high quality training and resources, it's crucial to understand that some people, due to lack of focus, dedication, or execution, will fail to derive any significant benefit from this or any similar training. This is not a get-rich-quick scheme. This is not a guaranteed pathway to success. Your personal effort, skill set, and other variables will largely dictate your level of success or failure. Jen and I will provide you the tools, all right? But how you use them is entirely your responsibility. And by continuing this training, you're acknowledging and accepting this anti-guarantee and taking full accountability for your own results. All right, we're getting to be big time when we have to put a disclaimer in there because our attorney says, yeah, you should do that. Okay, cool, we're doing it. All right, so for those of you who are new to our ecosystem, let me give you a quick snapshot of who we are, what we do, and why we are in a position to lead and train and mentor you guys. I am Stacy Conkey. I began my investing journey back in 2003, so 20 years ago, after attending a Tony Robbins event. It was UPW, and I basically came to the conclusion that I was on the wrong path. So I made the decision to leave my job in corporate America and dive into real estate full time. And it has been an incredible journey ever since. Lots of bumps along the ride. But it really gives me an opportunity to come and be able to teach and speak to you guys in a way to help you when you're just getting started, avoid all those pitfalls. In 2015, I met Jen when I was doing one-on-one coaching with students. And she had been doing real estate on the side since 2002, so actually even longer than me, while she was working her corporate job. So she did it as a side hustle. By 2016, Jen and I had both been to so many seminars on real estate investing, and we decided to take our first stab at learning syndication. Right? After a few months of implementing what we were taught, we realized it's so expensive, right? It's tough. It's a tough way to start apartments, right? You got to hire an SEC attorney. You have to get private placement memorandum. You have to find sponsors that will help you be able to get funding, because banks aren't going to loan you money on a property that's way bigger than anything you've ever done, right? So after banging our heads on the wall for a few months, we had a pivotal moment where we realized we could leverage the same strategy that we had used for acquiring our 2 to 4 unit properties, joint venture. And so after years of implementing and perfecting our joint venture apartment acquisition strategy, the Remote Multifamily Investing Academy was born. And it has become the #1 multifamily academy for teaching investors how to scale with apartments while leveraging joint venture first. And then we teach you how to syndicate. And that way you could actually truly close deals and succeed. So welcome to the weekly training, and buckle up, because we're about to drop some serious value bombs that will help catapult you into action versus being stuck where you are right now. And today, we're going to show you how asset management, all right, how it can impact your net operating income, or NOI, and how increasing your NOI has this massive multiplier effect on your property value. And you know what? That is where the real money is at. All right, so before we jump into the training, for those of you who don't yet know, and I'll give you an opportunity at the end to register, but I have to tell you about our first live event that we are opening to the public. I mean, it's not our first live event. It's the first live event that we are allowing people from the outside to come into. So it's WowCon, and it stands for the Warriors of Wealth Conference. our network within the Academy are warriors of wealth. And for those of you who want to get in on the inside with us and the members of the Academy, like this is your opportunity. We have never allowed anyone from the public to attend our events before. It's always been exclusive for Academy members. So this is the first time we're doing it. And the relationships that are formed at these events, they turn into joint ventures or joint venture deals and accountability partnerships. Like it is incredible. It's so powerful. Now, on the content side, our focus at this event is going to be all about seller financing. And I'll be teaching you everything related to how to get more deals done in the next several years, leveraging the powerful tool of seller financing. This particular strategy is perfect when you've moved, like what we just did, right? We moved from a period of low interest rates to a period of high interest rates. So it is exactly the right time for me to arm you with that knowledge. On top of that, I mean, there's so much different content that we do. I'm just going to give you a couple of bullets. Like Jen is also going to be teaching you about the 3 primary roles in multifamily that allow you to scale: acquisition manager, capital raiser, asset manager. And look, understanding which role best suits you allows you to learn all the parts of the real estate game. I want you guys to be able to step into any part of the deal and nail it. But the reality is there's one area that if you go deep in that area, you are going to shine. And Jen's going to be doing all the mindset sessions, which are going to absolutely blow your mind. All right, so that's a couple of things. We also are bringing in 4 outside speakers. So that is exciting. So we have a national multifamily lender coming to speak and to connect you with the best possible commercial lending that you can find, as well as being a connection for sponsors, for those of you wanting to get into deals that are bigger than you've done before. And you maybe need someone to come and co-sign on the loan who's got the net worth, who's got the balance sheet, and who has the experience. So she's bringing that. We're super excited about that. We also have a former hedge fund manager coming in to teach you how to attract money for your deals. We have another company coming in to teach you about how to get business funding. And we're bringing back Lisa Lewis, an absolute fan favorite. She spoke at our event in May and everyone raved about her talk. So we asked her to come back and she's going to be back and speaking for us. And for those of you who are ready to smash through your limiting beliefs and rock the next year, on the last day, Jen is going to be guiding you through an exercise where you will have an opportunity to break an arrow on your throat, a 40-pound arrow, just strong enough to kill a grizzly bear, right? It's optional. You don't have to do it. But for those of you who do, once you leave, there's literally no stopping you. It's incredible. Okay, so I'm going to show you guys just a quick video. Nope, it sounds like Siri's talking on the phone here. All right, I'll show you guys a quick video to give you a visual of the non-real estate parts of the event, which make the epic real estate sections actually seem like no big deal. All right, let's watch it.
You leave here with new hunger and desire to make your real estate dream come true. This is my 3rd one, and it just keeps getting better and better. It just keeps getting better.
Shot of energy for real estate investing.
You are taking a risk by going into real estate, so why not take a risk and develop relationships?
Very unexpected, a lot of fun.
It's a place where I get recharged and then I'm like ready to take on the world.
Throwing axes and doing golf, doing scavenger hunts all over town and doing all this fun, crazy stuff. You really get to know people, and it's in a really fun way.
Big part of it is the network.
Get together, play games. Just like last night, we all got together at the bar and everyone was just having a good time.
Oh, I got chills. Oh my gosh. Oh, I'm looking at the chat. Sorry about that. Sorry, I clicked on the chat because I see it and I paused the video. And I see, oh yeah, Diane and Ren are coming. Caroline Riley's coming. Thomas Wagner. I see, actually, there's a bunch of you who are here who are coming. And I cannot wait to see you guys. Many of you guys, I can't wait to see you again. Some of you get to see you for the first time. Anyway, all right. So let's get to some real estate, baby. You guys ready? In the chat, are you ready to go? Tell me. I don't want to be here by myself. LFG, yes, Wendy. Woo! Let's flip and go. Ready, right on. Oh, Will Huey, if you will change your little blue thing to everyone from hosts and panelists, that would be fabulous. And everybody can see your responses. And I'm very excited that you're here. Okay. Do you know which skill set in multifamily real estate has the biggest impact on how much money you can make on any given deal? In fairness, it's probably the least sexy sounding activity, yet the one that will make or break the success of your property, particularly if you're doing a value add deal and your goal is to increase the property value to maximize your equity and profit. Today, we're going to show you how asset management can impact your NOI and how increasing your NOI has this massive multiplier effect on your property value. All right. So why learn the skill of asset management? Look, we've noticed that a lot of people want to get into multifamily because they deeply desire a way to create passive income so that they can eventually feel what it's like to be free, to have the ability to leave their job and live life on their terms. The challenge is the part of the business that creates the cash flow, it comes later in the game. And it's the less sexy cousin to the acquisitions and the negotiations and the raising capital. That's all the sexy, exciting stuff for a lot of people. But if you want to truly build serious wealth in real estate investing and truly break free of the grind of your 9 to 5 or your 8 to 7 for some of you, learning the skill of world-class asset management is what is going to make you the big money. And I mean the FU money, right? Imagine what that day is going to be like. This is the part of the business that you really never hear the big seminar companies talking about. And frankly, that should scare the crap out of you. And you'll see why as we get into this. This is 100% the most important part of this business after you close. All right. By the way, if you're watching this as a replay on Facebook, please put #replay in the comments so that we know that you were here. I love it. Awesome. Okay. At the beginning of this training, I mentioned that we have a system for asset management. And today, I'm going to share our system for maximizing property value so that you can make more money with your multifamily deals and begin to live a life of hope and excitement and growth and purpose. And that's why we're here. So let's begin by talking about how apartment buildings are valued. So different from residential multifamily, right? Because we do both, 2 to 4 units, those are based on comparable sales. Apartment buildings are valued based on the net operating income. So why do we care about NOI? Because NOI, or net operating income, will be the metric that allows you to differentiate between the great life-changing deals and the crappy deals that will suck the life out of you and yield nothing at the end. So NOI is the revenue of the property minus operating expenses like, property management, marketing, property taxes, insurance, maintenance, things like that. Things we don't really want to pay, but we don't really have any choice. Debt service, which is the mortgage payment, is not included in the NOI. Okay, so debt service is not included. And why is that? It's because NOI reflects the performance of the property itself. The debt service payment would change depending on how someone financed the deal. So it doesn't speak to the value of the building itself or the performance. So let me give you an example. Let's say that you and your partners are going to put down 30% as a down payment. All right. And let's say that someone else was going to put down 60% because maybe they had a 1031 exchange. And so they were able to put a whole lot more capital down. Do you think at the end of the day, you're going to have a different set of financials? You're going to have different cash flow. Of course. Right? The most exciting thing about investing in apartments is the fact that we actually have the ability to change the value of the property just by running it better than the previous owner. By being the smart, educated investor, focusing on increasing revenue and or decreasing expenses, we raise the NOI. When we raise the NOI, we raise the property value. Okay, so how is that and how does that work? Let's get a little bit more specific so you can start to see how the things that you're going to learn today will impact the property value, which is literally going to impact your future and your ability to create generational wealth for your family. The value of a property is calculated by taking the NOI of the property and dividing it by the market cap rate. Okay, so in your notes, write that down. Property value equals NOI divided by market cap rate. Okay, so what the heck is a market cap rate? It's basically like saying, I'm not going to give you a technical definition, but it's basically like saying what level of ROI or return on investment do investors expect based on that market and that location? Okay, it's not the technical definition, but what I found is the technical definition doesn't help you understand anything. It confuses you more. I don't want to confuse you. I want you to get clarity. So I think explaining it this way will help you understand it best so that you can feel more confident as you move forward. So what I want to do is I want to show you and compare two different markets to help demonstrate this piece. All right, so one of our students, Temi Baligan, he is a mechanical engineer in Indiana. So at home where he lived in his home market, he had purchased 3 duplexes, and he was self-managing, but he wanted to get more economies of scale and he wanted to get more doors under one roof. The challenge was that, like many of you struggling to get started, the returns didn't work where he lived. So he came to us in order to learn not just how to invest in apartments, that was obviously one of the main things, but also how to choose a market that made sense based on his goals so that he could grow as an investor and feel confident in his ability to move forward with apartments. One of the markets that he landed on was Hartford, Connecticut, and he ended up buying 2 apartment buildings there. And just for a sec, I want you guys to close your eyes for just a minute. And I want you to envision it being 1 year from now, September 22nd, 2024. And now I'm teaching this exact same thing, but instead of Temi's name and Temi's buildings, talking about you and your buildings. It's pretty exciting when you begin to realize how doable this is for you. Anyway, Hartford, Connecticut had a market cap rate of 10%. Okay, so that's one. Some of our other students ended up closing a deal in Miami, right? The market cap rate there was 5.5%. So what is the difference and why is there such a big spread? So a lower cap rate means that the market is more valuable. Okay, it's the opposite. Lower cap rate, market is more valuable to investors and they're willing to accept a lower return in order to own property there. So investors buying in Hartford, Connecticut want to see a 10% cap rate, which is the NOI divided by the purchase price, right? Investors buying in Miami feel that the market is so much more desirable that they're willing to pay a much higher price. That ends up giving them cap rate only 5.5% because they feel like they want to own property there and they're okay with a lower return. So let's put some numbers to this so that you can see how it works and see why asset management is the bee's knees and why you want to learn and master it so that you can ditch the fear of how to do this and begin moving forward with your dreams. All right, so let's just say you have an apartment building that has an annual NOI of $100,000, right? And in Hartford, Connecticut, that building would be worth $100,000 divided by the 10% cap rate equals $1 million building value, right? That's how the calculation works. So in your notes, Hartford, but 100,000 NOI divided by 10% cap rate equals $1 million building value. All right, in a different market, Miami, if the cap rate is 5.5%, we would take that same NOI divided by 5.5% cap rate. The building value is 1.8 million. It could be the same building. I mean, it's obviously not, but it could be the same building, different location. Do you know about cap rates and how they impact the value? And if not, does it scare you to realize how different things are from residential real estate? That's the whole reason that we're here. That's why we want to educate you so that you can feel confident in your market selection based on what you are trying to accomplish. Now let's tie this into asset management, right? Let's say it's 9 months from now and you've closed on your second apartment building. Yeah, you, right? And let's just say it's a 20-unit building, right? And we can increase the rents by marginal, $25 a month on each unit. $25 a month on each unit, that doesn't even require any meaningful level of asset management. But I want to demonstrate the power of making improvements to the NOI and get you excited about what you can do. So if we have 20 units times $25 per month, that's an extra $500 per month, right? No big deal. So the very first thing we need to do, the first step is to annualize that $500. So we multiply it by 12 to come up with $6,000 a year. All right, so make sure you have your notes say that. Get all that down. And I will get hydrated. All right, well, I mean, for starters, $6,000 a year to your bottom line cash flow is something to celebrate, like for sure. But that is just the beginning. Let's see the impact of that $25 per month increase in Hartford and Miami and see what that looks like. All right. In Hartford, we would take that $6,000 and we would divide it by 10% cap rate. Okay, because we're trying to figure out what is the value increase. So we take the 6,000 annual increase to NOI divided by the market cap rate. So the impact to the property value is that it would go up by how much? You guys got your calculators out? Let's see it in the chat. I'm not going to tell you guys. I mean, I will, only after you tell me. So if we take $6,000, Ray, good job. Jen, good job. The $6,000 a year NOI increase divided by 10% cap rate, that means our property value increases by $60,000. Say what? A $60,000 increase in value just from a $25 per month increase in rent on 20 units? Yeah. And I know you're thinking, like, are you serious? Yes. Yes, I am. Now, just wait. What if you do that in a market with a lower cap rate? Like, let's use the Miami example. So we would take the $6,000 and divide it by 5.5%. So grab your calculators. What is $6,000 divided by 5.5%? $109,000. Good job, Carolyn. $109,000. No freaking way. So you make the tiniest change to your 20 unit building, just $25 a month increase, and you just made an extra $109,000. That's how it works in commercial real estate. That is why we're excited about teaching you guys apartment investing. Like, this stuff is getting way exciting. All right. Asset management can be broken into 3 high-level categories: increasing revenues, decreasing expenses, and strategic renovations, or CapEx. And CapEx is short for capital expenditures, right? Knowing this to be true, we are going to focus our attention on maximizing our revenues, minimizing our expenses, and prioritizing our CapEx spending on activities that will either increase revenue or reduce expenses so that you can create real wealth and see a future with hope and ditch the fears about the future that are probably keeping you up at night. I'll give you some examples of this using our most recent acquisition, which was a 96 unit building in Kentucky, just so that you can see how small, consistent actions can yield big results. All right, let's start with increasing revenue. When we purchased this property, we knew there was going to be an opportunity to make this property way more profitable. But how did we know that? So once you get a property under contract, you go into due diligence. And that's the time you're going to research everything to make sure that the deal still works. So when we conducted due diligence, we researched what market rents were in the area. And we compared market rents to what the property was currently getting. So in this particular case, the seller was really focused on just trying to get the units renovated and filled with bodies, right? So he clearly wasn't spending any time trying to maximize the revenue. So his focus was just elsewhere. Most of the units, when we did due diligence, were below current market rents. So the opportunity for our team was to identify exactly what we could get and start leasing out units at market rent. Another huge opportunity was to get the current residents to renew their leases either at or near market rent. So this kind of hits on both increasing revenue and, if done right, will definitely impact expenses in a good way. So if we're able to improve the living experience of the residents, they're far more likely to stay and renew their lease, right? Even if the rent is higher, rather than going through all of the expense and the hassle of moving. If our residents don't move out, we don't have unit turnover expense or vacancy expense, both of which can massively swing your NOI. It feels good. It feels fantastic to be resident focused and then start to see your annual renewals increasing. Like, that feels so good because not only do you make more money, which yay, obviously that's That's a big driver here, but you're actually doing a good thing. Like you are creating an environment that people enjoy being in. Like you're creating a home for people. Another common opportunity is utilities, which plays into both decreasing expenses and capital expenditures. So there's a lot of small apartment buildings where the landlord is paying for all of the utilities because the property isn't separately metered. Actually, just last night on our Academy apartment call, Lindsay, she had just submitted her first LOI yesterday on a 13 unit. And one of the things, the big upside opportunities that she identified was that the current owner was including all of the utilities. He was paying for all the utilities, not passing it along to the tenants, literally spending $34,000 a year. That's $34,000 negatively impacting the NOI of the building. So right off the bat, instituting a RUBS program, and RUBS stands for, it's RUBS, stands for Ratio Utility Billing System. And it basically, it's a way of taking the utility bills and then billing the tenants. And you have a third-party company that does that. But basically getting a RUBS program in place would get a large portion of the utility bills pushed out to the tenants, which will increase both the cash flow of the property and the value. Do you think that you could add value to a building by increasing revenues, decreasing expenses, and making strategic decisions about how to invest in the property if you learned how? Yeah, like, do you get excited when you think about owning an apartment building and identifying all the ways that it could be more profitable? All right, so let's do an example where you can tie some numbers into this. I mean, maybe some of you don't care about numbers. I just know for me, like I need numbers to understand concepts. So we're going to do that together. So I'm going to give you an example of a strategic improvement or CapEx related to utilities. So let's just say that your first purchase, your first apartment building is 10 units, right? Yes, your 10-unit building, right? And you found out that the seller was paying all the utilities because it wasn't separately metered. So let's take a look at what does that look like? All right. Now let's say that the monthly utility costs related to that building was $1,500 per month. Right? So always we multiply it by 12 to get the annualized impact. So it's $18,000 a year. All right. And let's say that it was going to cost $30,000 to take that project across the finish line. Ouch, right? 30 grand. Dang. But before we decide yay or nay, let's look at the impact on the value of the building. So we'll use a mid-range cap rate, right? 7% is not an uncommon cap rate for like the Midwest, right? So we'll use a 7% mid-range cap rate. So to determine what the value of that improvement is, we would need to take the annual impact on the NOI, which in this case is $18,000 because we're bringing the expenses down by 18 grand. That means our NOI went up by 18 grand. So we take the increase to NOI of 18,000 and divide it by the 7%. Anyone want to do a calculation and tell me what you come up with? It's $18,000 divided by a 7% cap rate. What is the impact? What is the impact? Nicole, great job. $257,000. $257,000. So we're going to spend $30,000 to increase the value of our property by $257,000 on top of bringing in an extra $18,000 of cash flow. Holy moly, right? This is the reason the students in our academy always look for deals where there is some kind of upside that can be captured through effective asset management. Because the payoff is huge. They get to enjoy the satisfaction of creating wealth for themselves and for their family. All right, our students, Teresa and Denise, many of you know them, right? They just finished up the summer on, they finished up the rehab, the value add activities they were doing on an 8-unit property. Isn't it pretty? They bought the property last November for $535,000. They invested about $180,000 in strategic improvements. In this case, it was mostly rehabbing units so they could then charge market rents. All right, so they were all in $715,000. Right, $715,000. So they completed the rehab. They had the property completely rented totally stabilized 9 months later. They're using a professional property manager, and they're going to be employing solid asset management for 5 years and then sell the property. That's their exit strategy. This is a 5-year hold for them. The projected property value in 5 years, based on the projected NOI, is $1,360,000. So they spent 9 months really focused on getting the property stabilized, dealing with contractors, like dealing with all of that and getting it rented. Well, the property manager got it rented, but they were dealing with it for 9 months. It's a 5-year hold. So that means the other 4 years and 3 months is them keeping in touch with the property manager, reviewing the reports every month, making sure the rents are at market and looking for value add opportunities. That takes a few hours a month, right? The property had an estimated 5-year value of $1,360,000. They're all in $715,000. So they basically have created through their efforts $645,000 in equity from understanding and implementing the skill of asset management. That's not an 8-unit building. That's not a tiny little building. Like, how do you think they're feeling about that now? Pretty damn good. Confident. Proud. It doesn't have to be some monster 100-unit building when you're getting started. A small apartment building, anywhere from 5 to 10 units or 10 to 20 units, is such a great place to start. You learn all the ins and outs of due diligence, financing, closing, and managing the asset. From your perspective, you gain knowledge and a ton of confidence. From an outside perspective, you gain credibility with all the parties that matter, the realtors, the brokers. They now see you as a closer, someone who can take a deal across the finish line. The lenders see that you're a closer, and all of your future joint venture partners who've been watching your progress. How incredible do you think that feels? It totally allows you to stand in your superhero stance, which I encourage. And it impacts all of the future conversations you're having with people. Just think about your own psychology for a second. And think about what it feels like to be able to say, I've closed on an apartment building. It completely changes the way that you're going to show up to all conversations going forward because you know you've done it. You're not having to fake it till you make it. You did it. And once you're done stabilizing that property, you look for your next apartment building. And then maybe you jump up to the next size, right? You learn what it's like to do all those things on a larger building. Then you close, stabilize that one, and then you do the next size building, right? So you're just stair-stepping it. It's a stair-step approach. And every time your knowledge, your experience, and your confidence are growing at an exponential rate. And as you get into larger properties, there's even more opportunity to increase revenues and decrease expenses. So there's so much opportunity to increase property value. You guys have so much opportunity in your future. So on our 96 unit, we bought that for $9.5 million. Right? Through asset management and the changes that we're making to the property, our 5-year exit, that's also the plan on this 5-year exit, 5-year exit value is $13.5 million. Well, that's a $4 million increase in value. Now, I don't recommend that you start with 96 units. Like, you really need to take some reps with smaller properties and work your way up. Otherwise, you could be making some pretty horrendous mistakes that could completely wipe you out. When you could have learned those lessons on smaller properties where it's a little easier to recover from those mistakes. If you can start with something that's, between 5 and 20 units, learn as much as you can, then employ our double your door count strategy, you'll be able to continue increasing your door count on every deal and getting into larger deals. And you'll know how to do them right because you have experience. And a big part of that experience is learning the frequency with which you need to communicate with your property manager. No matter what, one of the most important things you should always remember is that nobody cares about your property or your deal more than you. You have to always know what's going on with your properties. So you always need to review your reports so that you can ask questions that will likely drive more value to your properties. Asset management is more discipline and follow-up than anything else. And once you get the knowledge, because you can have all the knowledge, but if you don't actually do it, then it doesn't matter. So it requires discipline and follow-up. And it can literally make the difference between a base hit deal and a home run. This strategy is exactly what we teach our students in the academy, where we provide organized information and we remove a huge amount of their fear by holding their hand through their deals. With our guidance, they get to experience speed of implementation while building and managing their portfolios, and they're developing confidence and creating credibility for themselves with brokers and lenders and future joint venture partners and investors. Now, we're about to offer you guys something to get you into action. September is the last month of the third quarter. We are literally heading into the last quarter of 2023. How did that happen already? And we want you to be ready for the opportunities that are coming. So we all know the time to be ready is not the time to get ready. That being said, we've bundled training assets into a 5-day apartment acquisition accelerator that will help you take first steps towards acquiring your first or next apartment building. All right, this offer is for you if you've been stuck and you need some organized information so that you can get speed of implementation. So you can scan the QR code on the screen to access the checkout page. You can grab this incredible bundle for $47. Like, it's nothing. It's literally nothing. $47. We want you guys to have what you need to be able to continue moving forward. Ideally, we have you all eventually in the academy. I know many of you here are in the academy. You're doing apartments with us already. And for those of you who aren't, we want you in the academy. In the meantime, we want you in action. All right. So you can use the QR code, or you can use the bit.ly link that's on the screen, which is the bit.ly/5-day apartment. Okay, did you get that down? And remember, with bit.ly, capitalization matters. So make sure you capitalize the D, capitalize the A. All right. And speaking of taking action, if you identify as an action taker and you recognize that immersion is the best way to apply what you learn and get results, then you should absolutely plan on attending our in-person event, WowCon, the one I showed you about earlier. The Warriors of Wealth Conference, where our students come to learn advanced strategies for investing, plus they get access to our network of key partners that provide lending, business credit, and fundraising. In addition, I'm going to be teaching about seller financing. So as you guys know, we are in an interest rate environment that makes a lot of deals too skinny and not worth it. Up until 18 months ago, we had been in a long period of crazy low interest rates. So any multifamily owners that got a loan anytime in the past 5 years, they probably have fantastic rates and terms. Understanding how to offer and structure seller financing deals can help you take down deals that don't really pencil out when using conventional financing, and then turn them into incredible deals, utilizing the seller's low interest rate to create a huge win-win opportunity, both for you and for them. This is a skill that you're going to want to master over the next several years. So register for WowCon now. We only have 18 spots left for the public. It is filling up faster than we expected. All right. So there's the website. There's the QR code. Thank you guys for spending your time here. Thank you for joining us this week for our weekly training. If you want to go back and watch any part of this training again, you could do so in our Facebook group, Apartment Investing with Jen and Stacy, where we've been streaming this live, and it saves it there. Right. And then please don't hesitate to reach out if you want to explore like how we can help you, launch more quickly and more safely into the world of apartment investing. And join us next week for our weekly training. Next week, the topic is going to be all things financing. All right. It's going to be a good one. Guys, thank you so much for being here. I hope you have a fantastic weekend. It's been an honor to be here with you guys, and I look forward to seeing you next week.